All right. Good morning, everyone. We are recording this session. I just want everybody to know it will be posted to gbbr.org sometime within the next couple of weeks. I have to get it from one place to another. This is our second to last version of our seminars. We do have one more on Friday that if you would like to participate in, you are welcome to do so. I am Jennifer League. I am our Vice President of Operations here at GBBR, and I am going to be monitoring the chat for Charlie while we're doing this. We are going to ask everybody to stay muted. Put your question in the chat, and I can ask it for you, or I'll have you unmute for clarification, or however that works. Clint is very graciously going to share with us some tips and tricks on mortgage lending during this craziness, because he's been in the business for quite some time, although this is the craziest he's ever seen it, along with the rest of us. So Clint, you should have co-hosting capability to be able to share your screen. So whenever you are ready, go for it.
Okay. Let's see if I got this.
There you go.
Okay. See my PowerPoint?
Yep.
Okay, great. All right. Well, good day to everyone. Thank you for being here for this virtual session. My name is Clint Sell. I'm a residential lender for Meridian Bank, and been in the business for over 20 years. And I'm going to be sharing some up-to-date news and guidelines that I have seen since the pandemic has hit. It's all under this topic, mortgage lending in the new normal. And these are some things that you perhaps may or may not be aware of, and things that you may be able to share with your clients who are looking to buy a home, especially. Just a couple of disclaimers here. One is that I'm going to be kind of distilling an awful lot of information into this short presentation, the highlights, cliff notes, if you will, of what to watch for, and some background. The information here is constantly in a fluid situation. Things are always changing, so all items are subject to change now more than ever because of this pandemic going up and down. There will be questions and answers. Take advantage of the chat function if you would, and we'll try to keep up with it, and we will certainly make time at the end of the session to address those questions as well. And as you have been told, this class session will be available online at some point. So that having been said, I'm going to start by getting into some background as to the economic situation and industry situation leading up to and including the pandemic, and what the fallout has been since the pandemic. So I'm going to go through these first few pages rather quickly, and then I'm going to spend more time on the meat and potatoes as to the actual state of affairs with mortgage lending. Just some quick facts about before the pandemic. The economy was doing very, very well. It was on a record run of consecutive months of growth. I'll show you that in a chart in just a second. Unemployment was at 50-year lows. Stock market, as you know, was setting records, seemed like every other month. But at the same time, overall debt was rising dramatically, national debt being the highest since the Second World War, and personal debt had exceeded the Great Recession levels, and corporate debt is at an all-time high. And then there was talk about that notorious inverted yield curve and the threat that maybe we would be going into a recession in the near future. And I think partly because of that, the Federal Reserve cut down short-term interest rates to try to ward off recession concerns. So they did a couple of cuts, and they lowered interest rates in the short term, and refinances increased because mortgage interest rates followed shortly after. A couple of interesting little facts I'm going to throw in there. As of last year, non-bank lenders accounted for almost 2/3 of all new mortgages. That's going to come into play later. And just a little fun fact in case you didn't know that, did you know that Maryland was #2 in the country in median income? And did you know that Maryland is the second lowest in poverty in the country, Just a fun fact, I'm throwing it in there, okay? That's all I'm doing. Now, this is a chart you'll see on the top there that since the Great Recession up through this year, we've had the longest expansion of economic activity in however long it's been recorded, since the Second World War. So that was pretty impressive. But then the pandemic hit. And as we know, quarantine meant that people had to go home. Non-essential businesses were forced to close, and those that were still open had severe limitations and restrictions. And workforce had to transition, if they could, to an at-home type situation or not at all. And a lot of businesses laid off millions of workers. And this is a quick timeline of what's happened here in our state. And all this happened in mid to late March with non-essential businesses closed. Excuse me, and the governor was issuing the stay-at-home order at the end of March. And only not until mid-May did the beginning phases of reopening occur. And we're still in that process right now. So what did the Federal Reserve do to respond to the pandemic? Well, following this timeline again, mid-March, Federal Reserve lowered short-term interest rates to 0. It's never been that low since the Great Recession. And they started buying US Treasury bonds and mortgage-backed securities, a big, big amount that they were going to buy. And so as a result, that combined with the news of the pandemic caused the markets to react kind of Jekyll and Hyde. And then all of a sudden, places where mortgage lenders would normally sell their loans to on Wall Street, etc., they stopped buying or they limited the buying. So liquidity dried up, markets seized up, and certain mortgage programs vanished, and others were severely limited. So that, coupled with the fact that mortgage interest rates, while they were near historic lows at the time, interest rates shot up way, way high. So there was no rhyme or reason for that period of time, end of March. Then, as liquidity seized up, the Federal Reserve announced that they were not just going to buy a bunch of Treasury bonds and mortgage-backed securities. They pulled off all the stops and said, we are not going to limit any purchases. We're going to buy as much as needed. And this philosophy is similar to how the Federal Reserve combated the Great Recession with a policy known as quantitative easing by buying all these bonds and securities. So that, coupled with low interest rates, they were hoping to fight against this problem with the economy sagging. And then Congress passed a series of rescue bills for businesses and individuals, starting with the CARES Act. And one of the aspects of the CARES Act was forbearance for homeowners with mortgages. And I will go into that in just a bit. This last section here, CFPB, which stands for Consumer Financial Protection Bureau, cfpb.gov/housing. If you know of anybody who is having questions about their mortgage payments, maybe they're struggling or they know somebody who's struggling, they want any aspect of information, this is a very valuable website to go to. So I would urge you all to kind of jot that down or do a screen print or whatever you need to do, okay? So cfpb.gov/housing. Moving on from there, forbearance. So when you're a homeowner and you have a mortgage, you feel that there's some financial cash flow issues now or in the near future, or you're anticipating, you might be tempted to apply with your servicer for forbearance. You have to apply for this. And when you do, and it's accepted, it means that it allows you to not have to pay a mortgage for that given month when it is due. And the way that this is set up, you can renew this forbearance up to perhaps a year. It means that these payments are not forgiven. It only means that they are delayed. You have to catch up to it at some point. Now, technically, I've been told that this should not affect credit scores. However, it may very likely be on your credit report that you were in forbearance, okay? And lenders are going to make note of it, and it may have implications later, which we will get into. So let's just say that you applied for and did the forbearance. if you found that you were able to make payments, you should make those payments. Because if you miss payments and you're trying to apply for a new mortgage, whether it be a refinance or a purchase, it has implications. For people who are applying for conventional mortgages, those who missed payments must make up those payments with that servicer and show 3 consecutive monthly payments of, that are on time. It's better to make your payments if you're in forbearance than to delay and not make a payment, because it will cause a waiting period potentially. Okay, there are different little permutations in this rule. Okay, I'm not going to spend the whole class time talking about it, but I just want to make you aware that if you can, bring things up to date if you can, and if you don't miss any payments, you can do things much sooner than later. With government type loans, there has been no formal announcement from those entities, but the investors on Wall Street that purchase most of these mortgages, they have their own little set of rules and overlays, and there seems to be a trend, not across the board, but a trend that says that if you don't make your mortgage payment within the month that it is due, you may not get that FHA loan. Okay, so again, this is a fluid situation. We may hear something from HUD that formalizes what they plan to do, but this is what a lot of mortgage investors on Wall Street are saying. And with VA loans, you need to come up with an explanation as to why you went to forbearance and what you did to remedy the cause of that forbearance. And so that essentially is a case-by-case basis. These are all subject to each lender's overlays, their own little sets of rules. And when I say overlays, I would compare it to the federal government has a rule, individual states may have their little tweaks, their overlays. And that's exactly how mortgage lending is. They may have a rule from HUD, Fannie Mae, Freddie Mac, but individual banks that buy these loans have their overlays. So just be aware of that. That's all I'm saying, okay? As of the end of June, 8.39% of servicer portfolios were in forbearance. And most of these were those government loans like FHA and VA. And the Mortgage Bankers Association now estimates that a little over 4 million homeowners are in forbearance plans. Don't know if that number will go up, but if I had to make an educated guess, probably will go up, okay? What this does, aside from the individual strain on people like you or I, it affects mortgage servicers when they're hit with forbearance or non-payments. You know why? Because whoever owns that mortgage, the servicer may not be the one that owns that mortgage. Somebody owns that mortgage. So the servicer is kind of like a middleman. If they don't get paid the mortgage through non-payment or through forbearance, they still got to pay that other entity the mortgage payment. So if you've got a lot of people not paying their mortgage, this servicer is in cash flow trouble. A lot of servicers also happen to be mortgage lenders. You see where I'm going with this, folks? It means that they are going to try to become more conservative in their lending habits to new loans, because on the servicing end, they are not getting paid and they're starting to get a cash flow issue. And as I said before, these numbers are steadily, potentially going to rise. And my last point here on this page, a surge in repurchase claims against mortgage originators may grow because these servicers may find that these homeowners aren't paying them. They're going to go, you know what? I'm going to go back to the originator, whoever sold us this mortgage, and we're going to have them eat the loan. So you're going to start seeing this happen in the coming months, is my thinking, because this is similar to what happened in the Great Recession. A lot of servicers said, nah, we're not going to get stuck. You're going to have to take it back, originator. So it's caused a lot of originators cash flow issues. This is something that's not necessarily happening now or tomorrow, but in the coming months, it could be an issue. And if this does happen, somebody's mortgage loan might get transferred from servicer to servicer, which is not exactly the most pleasing thing to have your mortgage servicer changing on you. So these are just some implications to be aware of with forbearance. Forbearance can help people who are in need and have cash flow issues, but there are implications and consequences. So just be aware of that, okay?
Clinton, we have a quick question.
Yes,
Can I stop you for a quick question? Or
yes,
okay.
please.
So we have Kelly wants to know, is that why the credit score requirements went up?
Yes, that's a big part of it. I will get into that too in a bit about why they did that. But bottom line is, in a nutshell, if you're starting to see tightening guidelines across the board in terms of debt to income, reserves, credit scores, et cetera, even loan amounts or loan purpose, it's because of this kind of things. Lenders don't want to take a chance and take riskier loans. Riskier loans mean lower credit scores and that kind of thing. Now they're trying to protect themselves. So that is a good question. Yep. Okay. Any other?
Nope, that's it.
Okay. All right. Please stop me at any time if you need to. All right. So from fallout from the pandemic, businesses are slowly opening. We don't know when normal will be back again. You know, we're talking about the new normal, and I think this new normal is going to be with us for quite a while. Will there be another wave of infections? Some people say that we're still part of the first wave. We don't know. We're hearing news about spikes across the country. I don't know the answer to that. I just know that this thing is not going to be over tomorrow or next month. It's going to be with us for a while. The concept of teleworking from home, I'm working from home. I'm very, very lucky in that regard. Those of you out there who are able to work from home, you all are very lucky. A lot of folks can't, but those who can have been not going to the offices, and this has nothing to do with residential mortgages, but those who have commercial loans or manage or own commercial property, this has potential implications down the road, in my mind, huge implications. You might hear crickets in office buildings because people are going to realize that, oh, they're just as productive at home than in the office. Do we need that office? That's all I'm going to say. That's just my impression, and I'm going to leave it at that. So, next point. Remember I talked about how so many mortgages were originated by non-banks last year? Well, as with the recession, after the recession, the Fed forced banks, especially the top banks, to raise their reserves higher than they normally would. They also subjected them to what's known as stress tests to see if they could withstand economic calamity. And for the most part, the top banks passed that. So banks have reserves. Who do you think is going to withstand what's happening now and in the near future better? Banks probably would, because they've got the reserves. The non-banks don't have that kind of cash reserves. They don't. So you might start seeing some interesting things happening down the road as more and more people go into forbearance or just simply don't pay their home mortgage. This could be a big, big implication for non-banks that may have to get a bailout. So statistics, in the past 4 months, as many as 44 million people at various times have filed for unemployment. That number has certainly trended down recently. There's no question about it, because we're starting to reopen in various parts of the country. Don't know if that's going to sustain. Maybe it'll start growing again. But there's still as many as, I think, 13+ million people who are obtaining unemployment relief. And just to put it in perspective, there were a little over 15 million people that were on unemployment relief in the Great Recession. So we are in that territory right now. Recession could have a very, very slow, gradual recovery. I don't think anything's going to turn around real soon. It could take many months, could take longer. The Federal Reserve has promised that they will act in any way that they need to do to keep interest rates low. And this is a quote, they're going to keep interest rates low through at least 2022. Now, making a statement like that says something about what they think and what the duration of this could be. There's even talk about having negative short-term interest rates, which a few countries across the globe have had with mixed results. Don't know if we're going to go down there, but they are watching the situation and they are ready to act. Now, a couple other things that are not in our control. whatever we do here in this country is one thing, but globally, you know, there's a recession going on globally as well. There are other countries that were hit by this pandemic, so that could affect us. And you may be aware in the news that oil prices have bottomed out. That could also potentially affect the US economy and its recovery. There are layoffs that might happen again, even after these openings across the country. And we don't know how long the aid from Congress will last. There's talk about having another stimulus law passed. We don't know how long that'll continue for. If it stops, what does that mean? Do we have a massive round of layoffs and foreclosures? Don't know. It's all up in the air. But if there is a silver lining in all this, mortgage interest rates have dropped. Mortgage interest rates dropped to all-time lows a few weeks ago. The talk about having interest rates near 3%, even below 3% for some government loans, it's unbelievable. And there is no telling where this will lead. And for the short term and perhaps for the long term, interest rates look like they are poised to stay in a low area for a long time because the Fed wants the cost of borrowing to be as cheap as humanly possible to encourage borrowing, to encourage spending, because that's what keeps the economy going. So interest rates are low, so your buyers of homes, if they're qualified, they have more buying power, they can qualify for more home. It's huge for buyers, and it's huge if you have past clients who own homes. They can take advantage of this and refinance potentially. So here's the meat and potatoes of it. What does the pandemic mean for mortgage home loans? Well, as someone asked earlier, lenders are now being very, very risk averse, okay? It means that they want higher credit scores, they're going to restrict certain loan types, and they're also eyeballing very, very carefully income stability, particularly those that have variable income like self-employed and commissioned people. So I like to break this down into two different things. One is if you stay inside the box, and that is if you do a vanilla kind of loan with high credit scores, stable income, good reserves, good equity, and you stay within a certain loan amount, you're going to get the best interest rates without a question, okay? So that's staying inside the box. You get the best rates. If you go outside the box a little bit, like if you're doing a cash out refinance, for example, that's a little riskier, okay? Interest rate's a little higher, okay? If you do one of these different kinds of loans like construction loans or jumbo loans, interest rates are even higher. And unfortunately, jumbo loans have been penalized big time because there are fewer buyers for these kinds of loans. Fewer buyers means that these kinds of loans, these jumbo loans, have a higher risk. And it used to be, as recently as a few months ago, jumbo loans had interest rates that were comparable to normal conforming conventional loans. But now jumbo loans generally are significantly higher than conventional conforming loans. In fact, as I understand it, there's a top bank in the country, big bank, that won't do a jumbo loan unless you have $1 million showing in your reserves or your portfolio. That's what I understand. There is a national lender out there that will not even do a cash out refinance on your home. It's gotten to that state because cash out refinances are riskier than just a rate and term refinance. So understand what's going on here, okay? And this might be the trend of something down the road, okay? We're on a road, we don't know where it's gonna lead, so other lenders may follow suit. So anyway, higher rates if you go outside the box. There are those non-qualified loans that don't follow the regular rules of HUD, VA, Fannie Mae, Freddie Mac. Those like the stated type incomes or bank statement type loans that go way outside the box. Those for a while just vanished. They're starting to come back little by little. Interest rates are much higher, and watch out. Those things are coming back, but they could just as easily go away. So be aware of this, okay? And self-employed borrowers. Okay, underwriters are now scrutinizing their 2020 income. In many cases, I would say in all cases, they're going to ask for a year-to-date profit and loss. In some cases, they want to have that an audited profit and loss year-to-date, in addition to the past couple years of federal tax returns. They're going to want your bank statements to see if the cash flow makes sense. Are you making the same kind of income this year as you were in the past couple years? Maybe it dropped off entirely. They're going to be scrutinizing that, so be aware of that. It's best to get pre-qualified in advance. Now, good news is that most first-time buyer programs, like the mainstream ones, like the Maryland Mortgage Program, formerly CDA, and the Federal Home Loan Bank, those programs are still available as their funds are available. Federal Home Loan Bank may run out at the end of summer like they normally do, but those programs are still in force. Also, because the fact that a lot of sellers are hesitant to list their homes because of the pandemic, it's a tighter inventory on top of a tight inventory it was before. It means potential bidding wars on homes, and it also potentially means that there will be less seller help. So, govern yourselves accordingly, because there may be less help on the seller side for closing costs. The tighter guidelines, the unemployment that's happening, and the underemployment. A lot of people have jobs, but they're working fewer hours or getting paid less. It means that there may be fewer qualified buyers out there. Okay, so just understand that. And a little side note, housing wealth has never been as high as it is for seniors. Home equity for seniors has never been higher, which means that reverse mortgages still have a place in the lending world. Little aside there. You all should allow for longer processing times. I was just telling somebody earlier today that, the refinance boom has been pretty incredible, overwhelming for lenders. And we've been through refinance booms before, but another wrinkle to this was that for a couple months, the purchase business kind of like really was suppressed big time. And then we started opening up again. Purchase business exploded on top of the refinance business. So you've had refinances and purchases competing with each other. Obviously, lenders are going to prioritize purchase business for sure, but those purchases are taking a little bit longer now because they're all coming at once on top of all the refinance. So just make sure that you have the proper expectations with your clients in terms of processing these. Buyer or seller, they need to realize that it's taking longer because of the overall volume across the board. And mortgage interest rates are going to stay low for a while, as I said. They could even go lower. My feeling is they could drift down further. That's amazing, isn't it? It's great for someone who wants to do a refinance or buy a home. And as the refinances explode, people who are still qualified, they can cut their payments or take equity out and pay off that debt. I know some people that are guarding themselves against potential problems in the future by reducing their debt, by paying off that debt. So if you have past clients, it's a great idea to reconnect with them. And people, if you can send them their comparables for their neighborhood, they would appreciate it because they might think about it more and they would thank you for it. Could be another source of business for you. There is an ancient warrior named Sun Tzu who wrote a book called The Art of War. And one of the quotes that he has there, it is a famous quote: "Know the enemy and know yourself. You need not fear the result of 100 battles." So point is that, having knowledge, knowing your enemy, knowing what's happening, that's half the battle, okay? So I think that those of you that are on this virtual session, I applaud you for taking the time out, for listening, and I think that you and your buyers are now much better prepared than other folks out there wondering, well, what's going on? Why is this changing? I think now you know the why and how and what, okay? So the future is not given to us. We don't know what it'll bring, but be cautious, be prepared, talk to your lender, ask questions, and we can get all through this together. With that having been said, I think I've been spending about a half an hour on this. I would be glad to entertain any questions, if there are any questions.
Look, I'm not seeing anything hit the chat box yet.
Okay.
If anybody does have a question, drop it in the chat box. We can make sure we get your question answered.
Yeah.
That was very informative. Thank you so much.
Oh, good. Glad.
Thank you for attending. All right. If there are no questions, Clint, thank you so much for taking the time to put it all together for us. The recording will be posted to gbbr.org, hopefully within the next couple of weeks. I have to get them from this computer to a different computer to the web guy. So that all takes time. So hopefully we can get it up there. But thank you all so much for coming today. Hopefully our next one is going to be on Friday, and it's going to touch on a little bit on the mortgage side as well. So if you're interested in that, make sure you register at gbbr.org. All right, Glenn, thank you.
Thank you, Jen. Thank you all for listening. Appreciate it.
Have a great rest of your day, everybody.
Bye-bye now.
Thank you.